So this is the next video lesson following along the T3 trading and guidelines here. All right, and what I am going to do in this particular one, we're going to step through 3 different trades following these guidelines precisely. All right, and we'll look at 3 different market conditions. We're looking at the Russell 2000 here on the weekly time frame. And it's important to understand the market does really one of 3 things, right? It either moves up, moves sideways, or moves down. So those are the 3 situations that we're going to walk this trade through, all right? Now, first off, let's just look at a strong moving upwards market, all right? And the clearest one I can look at is right here, beginning of 2016. So let's go to 2/19 of 2016, and we will just set this up and we will show you how it reacts and how it performs in a strong moving up market. Okay, so again, we're just, for illustration's sake, we're just going to go right at 60 days to expiration, and we're going to construct this in the Russell combo. It's up to you to spend some time, and I will help you get it set up with the Russell and the IWM to start, but also into back testing and working through understanding how it reacts in OptionView. Okay, so we'll just come right here. This is Monday, February 15th, 2016. We're going to go to 60 days to expiration right here. The Russell is having a big up day. It's at 972. So we're just going to come first off, right off the bat, and come to 950. We're going to go 20, 10, 10, and what does that give us? That 900, 950, 1000. That gives us a delta of minus 32. All right. So what I want you to notice is when you are in higher volatility environment, like we are at this particular time period at the beginning of 2016. So when the volatility is high like this, it makes these butterflies much more inexpensive, and therefore we have a lot less benefit from the negative delta setup. All right, so that's what it looks like. If we added a in the money call at delta of 80, well, that gives us a very, very positive delta T+0 line, and we don't want that. So in higher volatility environments, sometimes you have to buy more butterflies. All right, and it's very simple to do so, and you'll see that we still have maybe a little too positive delta, but that is okay. As I said, it's okay to have your delta a little bit positive at the beginning, especially when you are coming off of this kind of a move here. So we'll just convert that right there, and we'll say, all right, this is a $30,000 margin that we're allocating. We are starting the trade out with a little over 20, and we'll just convert those trades and we will begin going. And if I am saying that I am targeting on these guidelines, my target profit is minimum 3 to 5%. As soon as that gets locked in, please consider closing the trade, especially if you are finding that you hit that very quickly, which is sometimes the case. So we'll step through a couple of days in time here. We'll just see that we go from right here, we've had a big up move day. We'll probably get a big deflation in volatility, and there you go. So again, if this is the situation you find yourself in, you are $885 profit on $23,000 worth of margin. That's 3.81% in 2 days worth of time. Please consider that a giant gift and collect it and close it and move on to the next trade. If you do not want to do that, then that is fine, but just understand that's that occasionally happens, and it's best to capture those profits and realize them. But let's say that we're holding out for larger gains, and we're going to say I want to target 10%, and I'm willing to risk 15% to get that. So 10% of 30,000 is 3,000. So I'm willing to risk $4,500 on this trade, and it is a long way away before I get to that point. Meaning, being down 4,500 is way underneath these short strikes here. Okay, so we'll just keep rolling forward a couple more days in time. We have some cushions that are built in the trade. We know that this is a bullish move because we looked at the chart prior to starting this. So this is one condition when the market moves up in your favor. As soon as we get above this upper long, we have to be considering to do something. If when price closes 10 points higher than the upper long, consider rolling the butterfly up 20 points. Notice it doesn't say mandatory, must do that. It says consider it. All right, and that's how you develop the awareness of how this trade reacts. Right here, the upper long is 1,000. We are currently at, in the Russell, 1010. It's a Friday. It's going into the weekend. If just because it says, well, we're 10 points above our upper long, I must do something. No, you're not a robot. And while, yes, it wouldn't be the end of the world if you did something like this and say you rolled up a portion of these, all right? That might be, yeah, that's way too much. You may roll up just, say, 2 of them, or you may even roll up 3 of them, all right? That gives you more protection to the upside while still keeping the majority of the downside structure intact. But your odds of retracing and coming back down are good. We don't know if this is the swing point low or not. So on a Friday, if you're hovering right around that area of needing to make an adjustment, and yet you see that what's going to happen, one of two things will happen. Either A, the market's going to reverse after the weekend, or B, it's going to go up to the upside. Either way, it does not matter on this type of trade as long as this T+0 is kept flat. So we'll just do nothing, and we'll say if Monday we move up and we close decisively higher than 10 points above that upper long, well, then we'll do something. And where are we at? We are from 1010 to 1021. So that is decisively higher. And you'll see we built more profits into the trade. So what do? Initial upside adjustments. If one price closes 10 points higher, consider rolling butterfly up 20 points. If you're in low volatility, consider only moving up the shorts. So what do? Well, we'll say I'm taking this, moving it up 20 points. Taking this, moving it up 20 points. Taking this, moving it up 20 points. And what you'll notice is it takes your existing trade, it moves the whole entire structure up, all right? It takes your existing trade that looks like this, moves the whole structure up. Oh, I did something wrong here. 15, 15, 30, 30. Oh, that's what I did. I didn't sell those. There we go. It's always something, isn't it? So this is your existing. This is the trade that you do, right? You're rolling up these lower ones here. You're rolling up these shorts to there. You're rolling up the upper longs to here. So you're taking an existing profile that looks like this, and you are making it look like this. So all you're doing is you're moving it up. You're following the market. And other than incurring some commission and a little bit of slippage, it doesn't change this T+0 line at all. And in fact, what you'll notice is it puts your shorts closer to where the market is trading at. Therefore, they will decay quicker than had you left them 20 points lower. So we convert it. Now, new subsequent adjustment is if when price trades at the upper long strike, consider rolling it up another 20 points, or under 30 days to expiration, move the shorts up. So keep that in your mind. One thing in option view, we'll need to go in and we need to reconcile these all to the same cycle so it allocates them appropriately. And we'll say now our new area is we are monitoring 1020. Okay, we know we're right there right now because we just had that move up and we just rolled the butterfly up 20 points, and that is good. That is okay. What we want to monitor and watch is if it continues going up higher, we have a little bit of time. We have a day or two. It doesn't have to, there's no urgency to where you have to get it done right away. So please understand that this is a relatively low stress way to trade because you're never going to miss the adjustment. And now what do you see? You go from being up 1100 to down 445. What in the world happened? Volatility flex happened. But you'll see your T plus 0 line is still flat. You are nowhere near your maximum loss, and you have to be able to weather that and handle that psychologically. It's going to float intraday as the market moves around. So if that stresses you out, just understand, keep a position size small enough so it does not stress you out. That is perfectly normal. That is what happens. The overall structure is intact, and you'll see our T plus 0 line is still relatively flat. But we are now well above this upper long, and we're starting to get a little bit delta negative. So we either roll it up another 20 points, that's a subsequent adjustment, or for under 30 days, we move the upper longs down. We are not under 30 days to expiration, so we move up. And you only do this twice, okay? So it takes your existing, it looks like this, and it does that, and so it moves these shorts up again. Okay, you're following the market. Do I know if this is going to win? No. Do I know if it's going to lose? No. But I know I'm following a plan, and you're following the setup, and you're following the guidelines, and you're just trailing wherever the market decides it wants to go. Meanwhile, your in the money call is making you a lot of money because you bought it for 113 and now it's worth 166. Your overall trade is still profitable. You have a flat T plus 0 line, and your volatility is starting to deflate. So it's a pretty relaxed, comfortable way to trade as long as you understand the mechanisms of how the short options decay and how this trade roams and breathes around. And so now where are we at? We're another 20-point move up. We're way out above this upper long. What are we going to do? Well, this says if when price trades at the upper long, we rolled it up. We already did that. We're not under 30 days to expiration. So what are we supposed to do? The market has just moved from 950 to 1050, 100 points in just a short period of time, couple of weeks, and yet here we are in danger of going underwater a little bit, but we have all this profit potential down here to the downside. And that's what you'll have to consider and ask yourself, do I roll it up a third time, or do I begin moving some of these upper longs down even though I'm not under 30 days to expiration? And that's the profile that you get. You can either do that or you can roll some of these up. Either way accomplishes the same thing. The bottom line is not to let this T plus 0 line get too delta negative or delta positive. This is getting too delta negative for my likings. So you just take a couple of these and you roll them up 10 or 20 points. I would say maybe we'll even do 4. And the barometer, what I'm using is we're cutting this in half. We're saying now I can handle a move continuing to the upside while still keeping the profit potential underneath. Convert that trades, come to the trade log, add that. All right, and then we'll just move a couple more days into the future. All right, and we just continue to move higher, We're way above this upper long. At this point, I personally do not suggest or advocate chasing this up. You've already rolled it up twice. You've got this big profitable range of this tent under the market. Now you're so far above these shorts. Now you just watch and see if it continues to the upside. Well, you just wait for it to hit your target profit as it blows out to the other side, or you wait for it to retrace and come back onto this level here. So you can see in the next 21 days or even the next 11 days, any kind of a retracement down gets you back into your acceptable target profit range. But we don't know what the market's going to do, if it's going to continue going up or if it's going to retrace. So now we have a Vega that has turned positive. We still have positive theta. Our delta is positive. There's no danger of ever hitting our maximum loss unless we get a significant gap open to the downside, and that's what you'll just be kind of monitoring. So step through a couple more days in the future. And you can see why backtesting takes so long, right? Because as you're developing your confidence and your understanding of the guidelines, you have to try different things to see how different things react. We're under 30 days to expiration now. It's starting to back off. It's starting to move up. We're at break even. We've already made 3 adjustments into this trade. 3 adjustments. So the mindset should be shifting towards this is probably not going to hit your target profit. Okay? You're getting under 30 days to expiration. You've already got another cycle that's getting ready to open up in a week or so. The tendency and the danger is to get married to these trades and just begin battling and fighting them because you don't want to not hit your target profit. And I cannot emphasize this enough. You were never in any danger of hitting your maximum loss. So this trade, although it did not hit target profit, can be considered a successful trade because the market went, 150 points up in a short period of time and you did not lose any money. Did you make your target profit? No, but this is one trade in a cycle of many. So this is what sometimes happens. And as you get closer and closer to expiration, you run the risk and the danger as gamma begins building. You'll see your theta's all but about gone now. You are positive Vega. So my consideration is, all right, this trade just didn't work. And that's sometimes what happens in super, super strong bullish moves when you're trading this setup of trade, this T3 model. Now, what we can do, and then I'll move on to the other 2 conditions, is we can go back and we can say, what if I put on an appropriate enough size that I was just going to say, I'm not going to make any adjustments. It's a set and forget. It's either going to hit target profit or hit maximum loss. All right? And that means we put it on, we make no adjustments. It was on the 15th, and we say, we're just going to let the trade breathe. What do you think that number is going to be? Right? And the reason for that is because look at what ended up happening. We moved so far, we were way past the upper long, and now we're in a situation to where if it keeps going, we can potentially make a pretty significant return without ever getting anywhere near hitting our maximum loss at 4,500. That's way down here. It would have to move, almost a 20% move down to risk our maximum loss. Okay, so I say that and I throw that out there because just because you have all these adjustment considerations that I've put on this PDF, that is only one way to do this. A very viable method is to say, you know what, I'm just going to put it on and I'm not going to adjust it at all. It's either going to hit target profit, whether that's you decide it's 2%, 5%, 10%, 1%, or it's going to hit maximum loss. And it's no adjusting. It's set and forget. And that's very valid. It's a very viable way to trade this. So that's the strong bullish up moving situation. So the flip side of that is, let's go into a very healthy move down, and we can look at obviously 2008 or even 2011, either one, but we'll go to 2008 and we'll go right here. Let's just go middle of September 2008 before it really began to unravel. Okay, so we'll go September. I'm not quite sure if the 22nd is going to be our 60 days or not, but yeah, perfect. So we've got a 33-point move down. This is what has just happened. And we're going to say, all right, well, it's 60 days to expiration. I think it's just a retracement. It's going to be a buying opportunity, and we're just going to keep heading back up. All right. If that's your belief, we just put this on. We just follow the guidelines. You'll see that we've got Russell at 720, so we'll come to 700. We'll do 20, 10, 10. That gives us the delta of minus 41. We come up here to a delta of 80 by 1. And then kind of the same thing. We're going to have to experiment with the contract size to get our, it might be just a little bit much, so we'll go 13. Oops. All right, that's good. That's good enough to get us started. So what we'll say is, well, maybe we'll just do 12. Let's do 12. No, that's even more. Oh, perfect. There we go. All right, so it keeps us above the T+0 line, but it gives us still a little bit of room to the downside. We will convert that trade. We will come in here, and we will say, all right, now let's get rolling. Let's get started. $25,000 trade to start. We're allocating 30,000. I don't want to lose any more than 4,500, and yet I'd like to make anywhere from 5 to 10%. Okay, so that's the starting parameters. We'll roll forward a couple of days, and we'll see that where are we at? We are under the short strikes. So we open this, and right away we had 2 more days of downward moving. We are now under the short strikes. So initial downside adjustment, if when price trades 20 points under the short strike, consider rolling butterfly down. We're at the short strike right now. We're a third of the way to hitting our maximum loss. We go from 700 to 680. We're still not at our maximum loss, but maximum loss is fast approaching. Okay, so we'll go a couple more days. And we've rebounded back up. We'll just keep going here until we get the nice big flush down. All right, so we are well underneath the short strikes now. Let's go back to the date that it happened. So it closed there at 6:57, so we need to go back to Monday the 29th. And this is the day when we're down, Russell's down 46 points. We are well underneath our short strikes, and we are well over our maximum loss. Okay, so what do you think we should do? Do we close the trade? Do we keep the trade open? The trade is well under our short strikes, and you have just experienced this kind of a move, 100 points down in 4 days, and you've had the volatility just explode. So at this point in time, you close your trade. And I'll tell you why you do that is because you've already more than violated your maximum loss. This is a very historic condition. Obviously, looking back in hindsight, we know this was just a beginning of a massive unwinding in the real estate market, but yet we don't know when that next one is going to occur. So if you're violating our rules and we're saying we're more than maximum loss, let me start adjusting it, well, that's a bad habit to get into. And I'll show you if you just say, well, I'm just going to follow the rules and I don't care about max loss, I'm just going to do it. Well, what's going to happen is now you have locked in, and you have locked in that loss. You have put yourself on risk for even a greater loss if it keeps moving down, and we know it does, because you're unwilling to emotionally or psychologically take the loss. And that is absolutely one thing that you have to accept and get in your brain. If you're going to be a trader, you have to 100% understand and accept the maximum loss and honor it. And I don't want you to begin developing those bad habits of violating your maximum loss. We put the maximum loss in a trade plan for a reason, and you have to honor that. All right, but let's just say that you didn't, and now you're in this kind of situation. And now the trade is, you still got about the same amount of margin at risk, but now where are we at? We go from 671. It's going to take a second to update. To 619 in a couple of days. We're way down under after you've already made that first adjustment in that roll. And what has it done? It's just now in free fall mode. All right. So now, where do you think your mindset is going to be, thinking or knowing, you know what, I could have gotten out of this trade only being down at my maximum loss, and now I'm in this kind of situation. Great. Now what do I do, right? And what's going to happen, trust me on this one, is you're going to get very emotionally engaged and involved with it, and you're going to have a very difficult time further taking a larger max loss, and you're going to start fighting it. And then you're going to start saying, well, you know what, it's got to retrace, and so let me just go down again. Let me just roll it down 20 more points. Oops, sorry about that. And I'm just telling you, it's not a good habit or a good pattern to get into, because once you start doing that, you begin just violating everything that trading is all about. Because even if it does reverse and come back up, well, where are you going to be at? You're still going to be so far underwater. This trade is not salvageable. All right? And so why continue making adjustments on it? Just don't do it. And that's all I'll say about that. So honor your maximum loss. If the maximum loss is too big and you're unwilling to take the maximum loss, then you have to really ask yourself why not. Because here's the next thing to consider. Let's go back and let's say, well, we took the maximum loss when it hit it on the 29th. I closed up my trade and I hit my maximum loss. If I would not have, I'd be, really taking it on the chin. So let's say we've taken our $5,000 maximum loss on that particular trade. Trade is over. That one is dead. Well, what do you think would be a good opportunity to enter the next trade when the volatility is exploding and you've got a market that's basically doing this? Well, I know what a lot of traders, myself included, did is waited until that base firmed. All right, because here's the market's not going to zero, right? I mean, I guess technically it could, but right? I mean, it kept going. It was free fall mode, and you cannot step in front of that thinking you're going to catch that. What do they say? Don't catch a falling knife. You just have to wait, and you have to be able to sit on your hands. All right, so this first candle, this might be a very good opportunity to get in the next cycle, knowing that you're coming off of the heels of a maximum loss trade. But let's wait one more day and see what happens. All right, so now odds are pretty good that you can come into the market now and you can say, all right, well, I got 67 days, and that's okay. It's different than 60, but I can absolutely decide to come in at 550. Get on here, and I mean, you know, this is a direct impact of what increased volatility does. Look at how high that delta is. So, you know, we may even have to buy 15 or 16 of these. I mean, and that, you know, that gets our delta at what, a 34. So, you know, I mean, that would be fine. And let's say we convert that. Now, you're back to your original format. You're, yes, Matt, coming off of the heels of a maximum loss, but we come through even just to the end of that week. And what's going to happen when this volatility deflates? All right, well, what happened? We continue dropping. We rallied up, and then we continued dropping 20 points under our short strike. So what do? We roll back, and this is trading, guys. I mean, is it an absolute science? No. Is it an absolute art? No. But it's a mixture of the two, and you take both of those and you combine them together, and you can say, all right, well, I'm taking a little bit of drawdown. It's the second trade in a row. I'm coming off the heels of a maximum loss. If we get 20 points under, I am going to have to be prepared to make a second adjustment or close this trade up and take two back-to-back max loss trades. All right, and that's exactly what you do. When that situation occurs and that happens, and actually we'll probably have to back up one more day when we hit our maximum loss. Nope. All right. So, and that's sometimes what happens. And you say, well, you know what? I tried and it did not work. So now you're coming off the heels of two back-to-back max loss trades. And if that's uncomfortable for you to accept or to handle, then you've got to create the appropriate position size. And that's why I think this Russell IWM combo is very good while you're learning the nuances, because then we can say, well, let me go another week. Now I'm done with November. I'm done with December. I'm going to start getting ready to play in the January cycle. And now we've had a nice flush down. This could be the bottom. Let me just wait for another week or so. Again, there's no urgency to get in these trades. Now, what do we have? We have the rotation retracement back to 500. We're at 70 days to expiration. We'll just open it again on the next Monday when there's 67 days to expiration. And we'll say, all right, this is the price. This is where we're at. I'm just going to come right in and I'm going to just do it again. So 490, I'm going to go 20, 10, 10, and we'll come up here to 80 and buy one. Again, delta's way too positive, so we're going to probably have to do 15 or even more to get that delta, you know, around where we need to be. It's going to be the same kind of setup, and we just convert the trade. So we go to the end of the first week. We're on the heels of two maximum loss trades. This is a pretty historic move, right? That's happened. And remember, we got back into it way back in here, and it just completely just kept cratering. Now it dropped, and now it's starting to bounce around and rotate around. And we're 20 points under our short strikes again. So you roll it back. You follow the rules while you're learning how this trade responds. Convert, trade log, and we'll just put the reconcile on all this. And when I say that, you know, you can get skilled in all market conditions, I truly, truly believe that this is how you do it. Because markets are going to do one of two things. They're either going to go up, they're going to go down, or they're going to go sideways. And now what do? We had a market that continued dropping. We'll have to go back here to this day. And we'll say, well, where were we at under our shorts? We're under the shorts here. Go to this day here. All right, so we're right at the short strikes here. This day, are we going to go 20 points under the short strikes? Yes. Are we at our maximum loss? Yes. Number 3, max loss. All right. So guys, I mean, this is the absolute reality of sometimes what happens in trading. November, December, January have all been losers. Now we wait for February. Okay? So you can take this lesson and this experience to say, wow, it really puts things into perspective a little bit differently. Am I prepared to do that? And if I'm not, well, then, why am I not able to do so? Because is this the bottom now? We tried to get into the next cycle after here, and that one stopped us out. We tried it here, and that one stopped us out after coming off of this one here. So we've had 3 consecutive trades. Do you stop trading just because you've had 3 losers in a row? Or do you say, this is trading, I'm following my plan, I know the edge is in my favor, I'm not ready to open up February yet, so let's just wait until that Monday to where these fall into that range. And this would absolutely probably be perfectly viable to do. We've got, now swing point, some firm base, we could absolutely find ourselves heading back higher. So we're going to go in again, and we're going to say we're going to just follow the plan. And we're going to say, here's this, and here's this. Again, delta's way too high positive, so we'll do 15, and this one might even actually have to be more than that. Yeah, this one I think is going to have to be 20. All right, so we'll convert that, and then we'll go to the end of that first week. And you don't abandon a method just because you're hitting your stop losses and you're stopping out. That's trading, and you have to be prepared and willing to honor that. Because now look at where you're at in this situation. You've got extraordinarily high volatility. You've got a lot of contracts on for about the same amount of margin, and the market's not going to zero. I mean, it probably feels like it at times, and I know during this point in time, it definitely felt like, the end was not in sight. But, as we know in hindsight now, this was the swing point bottom low, and you're coming off of 3 losing trades in a row that should not have the ability to wipe out your entire account. And yet, here you sit, you're 10% of margin in profit with a very nice flat T+0 line. And when this volatility deflates, that T+0 line, I'm going to show you something here in just a quick second. All right, when the volatility deflates, see how that T+0 line shifts up? All right, so you can find yourself, the reverse is obviously true too, if if the volatility increases, it deflates. But when that volatility comes out, because we are in extremely high vol coming down, profits just rush into these trades, and you still have a very flat T+0 line. So again, you've recovered one of your max loss trades, and yet there is really no reason to close this trade unless you just want to capture those profits. Those are choices to make, but the methods work. The edge is 100% in your favor with this trading setup, and yet I think the biggest lesson I want you to take away from this is you have to 1,000,000% honor your maximum loss. All right, so obviously you can see that trade became a winner after the 3 became losers in a row. And then the last, I'll just run through a real quick situation where we have the sideways range bound markets, because that's obviously the ideal scenario, right, with this strategy and this setup. And we can just I don't know, let's go to, I don't know, this is a pretty sideways range beginning of 2012, and I'll run through a really quick 2012. We'll just go February 13th, and we'll see where our days to expiration are. 67 days. We'll go one more week then. All right, so follow the same construct. Russell's 830, we'll go 20 points under. And we'll come right at a delta of 80. Gives us a little bit positive delta, good positive theta, negative vega. Gives us that sloping, slightly sloping upward T plus 0 line. So we convert the trade. Look at how much less margin this requires when this volatility is that low. Okay, fewer contracts is going to react differently than when you have a lot of contracts in a much higher vol environment. So we'll go to the end of the first week, and we know that this area just kind of ranges around. It doesn't really go explosively, to one side or the other. It just kind of stays in this sideways range while we wait for the target profits to build. And when the target profits are hit, whether that's 3% or 5% or 10%, whatever it is that you are targeting, well, then you close up your trade. Or what you say is, all right, I'm above my target profit. I don't want to close a trade. What I do want to do though is keep my T plus 0 line flat. I keep the in the money call, and I just begin unwinding and selling portions of them out. And look at what that does for you. That takes this, where you have really no danger, no jeopardy of losing this trade now. $4,500 is your maximum loss, but you can say, I'm up 37, let me protect it to 25, so I will let it float between 785 and 840. Meanwhile, what I'm going to do is I'm going to unwind a portion of these and say, I take this profile and I create the green profile, and now I have a trade that looks like this. Now, my $2,500 that I'm going to protect, I can still hit it about here, 790, a little bit higher than 785. But now, look at that. I've got that locked in, baby, all the way up to the upside. And you begin doing that, and that's one way to protect and preserve the profits if you're not ready to just close it up at your take profit level. And that's maybe more of intermediate to advanced maneuvers after you have a little bit of time in the cockpit trading this method. But once you'll see that, all right, we're still right here. We're still got 37 days to expiration. We can go another week into the future. Delta's nice and neutral. Theta's nice and positive. We're still building profits. Still nothing to do. But notice, apologize, I'm not trying to jump around so much, but notice how this is beginning to change shape. The slope is changing. Instead of being pretty flat, it's starting to get this kind of rounding look to it. And so how do we overcome that? Is we just say, well, let me just sell out a couple more, right? I mean, it's a very simple maneuver. You begin unwinding the trade. So now I've taken 100% of risk off of the upside. I don't care about this going to the upside anywhere. Now I only am defending it to maybe say 800. And now I'm locking in, instead of 2,500, 4,000 or 4,500 or 3,500, whatever your variable is. And you can say this trade is going to be a gigantic winner. And as I said, optimum is greater than 15%, but highly unlikely when first beginning. Realistic is between 5 to 10%. In this example, you're already well above that. You're removing risk with each subsequent adjustment, and you're putting yourself in a very profitable scenario. Okay, so that's the sideways ranging market, and I think that gives you a good starting point to look at 3 different scenarios, raging up market, raging down market, and then a sideways market, and let you see how this reacts in all varying conditions. And we know that the majority of the time, let's do this. The majority of the time, what do the markets do? The markets, the majority of the time, they go up a little and they come down. They go up a little and they come down. They have periods where they break out and they move up pretty high, and then they have periods where they break down and drop pretty significantly. Taking out 2008 that we just went through and I showed you, and 2011, this market just kind of moves around up and down, and the daily paces. And this method, this strategy works very well to take advantage of that. Okay, so it will take time, it will take effort and work on your part, but I think it will be well worth your hours and time spent testing it and learning it so that you can understand how it does perform. Okay, so on to the next one. Thanks, guys.